Hey, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we are starting off this week for the first time in quite a few weeks in a much more cautiously optimistic tone here with the broader markets. You have the major equity indices like the S&P 500 cracking above a major resistance level at 5,500 here, just cracking above it, not quite, I would say, sufficiently there, but certainly some early signs of improvement and recovery here for the equity markets. Now, when we have shifted our tone here a little bit over the past few weeks from something that was initially quite bearish to more neutral to now taking a bit of a cautiously optimistic tone here to the broader markets, whenever we see a shift in our overall outlook, we have to take that with a grain of salt and just be aware of the risks that come with shifting our overall view here from a macro perspective. So during today's session, what I want to be clear are, why we are taking a more optimistic tone here in the equity markets. At the same time, understanding what are the potential risks with that to help you better navigate this particular market environment that we find ourselves in. So the S&P 500 reclaiming major support and resistance level. You have QQQ, the Nasdaq 100 ETF, similarly to the S&P 500, getting back above a major resistance level and holding that level here as of yesterday's close is a relatively strong change to the overall outlook. And then if you look at IWM small cap, you basically have seen, those kind of get back to those levels here as well. But be aware that, the small caps have not managed to break back above that major resistance level here. Hopefully in the next couple of days, we do see that in conjunction with what we're seeing on the S&P and the NASDAQ. But right now, the small caps are lagging behind the mega cap indices. And then you also see equal weight S&P 500 getting back to that 168 level, but not quite getting able to close back above that level and sustain that close. So overall, equity is starting to see some signs of improvement. Those signs of improvement are not quite just yet across the board, and there are some downside risks with that assumption here. So it's important to understand that before you shift your tone here in the broader markets and understand kind of what the shift in the tone comes with in regards to risk. We continue to see growth. We had value outperform growth, but we're starting to see some early signs of growth coming back to life and outperforming value here again. That's part of the shift that we started to notice here over the past couple of weeks. Is a shift in terms of what part of the market is actually contributing to outperformance, and we'll take a look at that also deeper. When we look at sector rotation, you have commodities that really fell apart quite a bit here over the last couple of weeks with oil reaching new 52-week lows. And despite gold also reaching new 52-week highs, we've really seen commodities overall moderate a little bit as both of these assets are kind of reeling in from their extremes from over a week ago. You have HYG high yield corporate bonds that have continued to rally above that 50-day moving average. This is a more English this is more of an indicator that's really important because we have to understand what the bond market is concerned about, especially around credit. The slowdown that we started to see in terms of consumer spending in travel categories The question is whether that slowdown in spending will make its way across the economy, and if there are concerns that different levels of creditors, especially on the high yield side, are starting to have some issues with repaying their debt. We're going to see that show up here in ETFs like HYG. So at the moment, we're not necessarily seeing that level of stress or concern here from the debt markets, which generates more of a risk-on environment at the moment for equities, which is overall positive. You have the VIX trading below just around 25% here. So the VIX has stalled a little bit in terms of its retreat. You do have VVIX back below 100% as well. That is also a relatively constructive metric for taking a more bullish tone here for the equity markets. And then you have 10-year yields that have declined a little bit, but still remain fairly elevated, about 4.3% here on the 10-year yield. It's definitely a little higher than what I think a lot of investors would like 10-year yields to be at. At the moment, the bond markets are pricing in a 25 basis point cut here in the June FOMC meeting. And lowering interest rates is definitely something that would provide a relatively strong backdrop here for equities going forward. So looking at lowering interest rates is definitely something that a lot of investors have priced into the bond market and are looking for here over the next couple of months for clarity from Chairman Powell on that specific path of potentially cutting rates multiple times in 2025. And then you look at treasuries here, we're basically at a pretty pivotal level here, the 50-day moving average. And this level has provided as a resistance level here over the last couple of weeks. The question is whether the bond market can stage a rally here, break out above that 50-day moving average. Is what we're currently looking for to see over the next couple of weeks. At the moment, I do think that it is struggling a little bit here with getting above that major resistance level. One big concern that I do have here with taking a more optimistic tone here for the equity markets is the sell-off that we've seen here in the US dollar. We continue to see the US dollar being under pressure here. The US dollar was not able to recover from its relatively strong sell-off here that we saw over the last couple of months. And the failure to get back above $100 and continue to trade lower here is a big concern, just as the overall safety of the US dollar and the perceived risk-free rate of the US dollar. If that were to ever be put into question, which you could argue there's some questioning around that here right now, if that were to ever be put into question, the ramifications of US Treasury debt not being risk-free is measured in the trillions of dollars of assets that is priced using the US interest rates as risk-free. So, if any concerns on that front is likely going to lead to some form of financial crisis. We're obviously not there at the moment, but that's really where this could go, and that is, in my opinion, the biggest risk that I see here with the markets at the moment. And then we see gold continuing to climb to that 3,500 and pulling back here a little bit to that 3,300 level. You have the oil prices declining as low as $56, finding a little bit of stability here around $62. But overall, gold in a strong uptrend and vice versa, oil in a strong downtrend, with gold being the safe haven trade in oil, really reflecting a weakening demand from the global economy for oil. And then looking at sector rotation, this is really where for many, many weeks, we've been talking about the fact that there's been a lack of rotation. We saw rotation into the more consumer staple, or rather staple type and defensive sectors like consumer staples, healthcare, utilities, even energy. We've seen a lot of inflows into those specific industries over the past 4 or 5 weeks. And this is really the first time that we're starting to see a little bit of a glimpse of some of the weakest sectors like technology starting to show some signs of life and some shines of outperformance. So we're seeing that here in tech. We're seeing that in consumer discretionary, and we're also seeing that here in communications. Those are the 3 sectors that remain relatively strong here, given the market conditions that we find ourselves in. And then if we look at some of the other sectors like financials, you look at consumer staples, you look at healthcare, some of the more defensive sectors that have been driving the inflows over the past few weeks, these are actually the sectors that are starting to see some of the largest outflows as we start to see, the equity markets take a bit of a turn for the better. We're also starting to see some sector rotation, which ultimately is healthy for the equity markets. You need to have a healthy amount of rotation in order for markets to continue moving higher here. So we're starting to see some of the early days of that. So that puts us kind of where we are with regards to the overall sectors, and looking at some of the ideas here for today. First thing we want to take a look at here are some of the symbols here for the day. Let's take a look. 1 second. Guys, give me 1 second. I'll be right back. So looking at some of the stocks in our buy list, the first one I want to point out here is some of the tech names, and Alphabet falls into that particular category. What we're really looking for are bounce candidates on stocks that have really been beaten up here over the past couple of weeks, rather past couple of months, have started to show some signs of bottoming and has the potential here to bounce, both from a technical and fundamental perspective. And Alphabet certainly falls into that particular category. This is a stock that's taken about a 25% haircut in terms of valuation over the past 2.5 months. And now trades at a very, very reasonable 17 times forward earnings. And we've recently reached this 147.5 support level here multiple times and bounced off of it. And that's really what provides the basis for what could be a bounce up into that 190 upside target here that we have here for Alphabet. Let's take a look at some of the other symbols here. Airbnb. Airbnb, similarly, as you can see here, has taken a bit of a significant haircut here over the past couple of weeks, but really over the last couple of months. Then over the last couple of weeks, we started to see this bottoming start to form and provides, the potential bounce candidate here, going into what could be a more healthy and more healthy and more optimistic tone here for the equity markets, in terms of Airbnb, also trading at a pretty significant discount from a valuation perspective. But more importantly, Airbnb grows at a much faster expected growth rate and is far more profitable than its industry peers, which is what makes Airbnb a fairly attractive play here, both on a technical and fundamental perspective. You have Netflix that I think is also worth paying attention to here, recently breaking out to new 52-week highs here. The breakout here above 1050 is fairly constructive because not only is it breaking out on absolute terms, it's breaking out on relative terms as well. That's exactly what you typically want to see on equities that are breaking out to new 52-week highs, is that they're doing it, not only relative to themselves, but they're doing it relative to the overall market. And Netflix, while probably on a lot of investors' radars, at the moment, actually still providing both a technical and fundamental thesis for the move here. Netflix essentially trades in line with the industry, even though it's expected to grow faster than the industry and is far more profitable in the industry as well. Another one that I thought was interesting to take a look at here, stock that we probably haven't taken a look at too much here over the last couple of years, which is Zoom. Zoom, as you can see, has taken a bit of a hit here over the last 4 or 5 months here, but it's really started to form a little bit of a base here above $72. And what we're looking for that is that base to actually break out here to the upside into that low $90 range. And Zoom, just like Netflix, trades at a very reasonable valuation, especially if you look at kind of how fast it's expected to grow and its profitability as well. Let's take a look at Microsoft. This is another one that I think is sort of flying under the radar a little bit, even though it's obviously a very widely held stock. As you can see, Microsoft kind of trading below this $395, $400 level here, forming this bit of a base here, really has the potential for it to break out here into that 425, 430 level here. Microsoft, on the Magnificent Seven perspective, is one of the more expensive stocks. But if you look at just how solid the earnings for Microsoft have been, especially if you look at profitability and just how far it exceeds its industry, I would say that its valuation is more than justified and still represents a fair amount of upside, considering it's taken a pretty substantial haircut on valuations over the past 3 months or so. And then looking at one last one, which is Applied Materials, a semiconductor stock. We haven't really taken a lot of semiconductor stocks lately because of just how poor the industry has continued to perform. But really, what we're looking for is some signs of a bottom here for stocks in the semiconductor industry, such as Applied Materials. And this is really what we're looking for, is potential breakout from that 150 level here to the upside on Applied Materials. Applied Materials also trading at a very reasonable valuation, especially if you look at the fact that they are far more profitable than the industry. And I'll leave you actually with one last idea here to the upside, which is XYZ, or Block. This is a stock that we've liked a lot throughout last year, and we were actually able to catch a lot of this particular base and the breakout here from that base. It went from $70 quickly into that $100 range very quickly, but over the last a few months, it's taken again a huge haircut. It went from a $100 stock to a $50 stock that effectively halved. And what we see is a very similar setup here. Basically, you start to see some signs of a bottom here. You can draw your lines a few different ways, but basically the breakout here above 57.5 is constructive for what could be, a breakout here towards new recent highs here, and targeting that gap fill level here, which comes in around just slightly above $80. So a very strong risk to reward here to the upside, looking at stocks like Block. And then looking at some of the bearish stocks. So one stock that I think is worth mentioning here is T-Mobile. We've seen T-Mobile be a very resilient stock, but start to show some signs of concern here over the last couple of trading sessions here. Whoops, let me draw this line better. So if you look at kind of this trading range that it was in here between 250 and 275, we basically broke out to a new 52-week high, traded in this range between 250 and 275. And instead of continuing to break out to the upside, we've now broken down to the downside. And that's a pretty significant sign that things are starting to show a little bit of a crack here. And T-Mobile has historically always traded at a very rich premium relative to the industry because it is far more profitable than its peers. But that's really something that we could start to see some margin compression on, which is just how profitable they are. And that's why I think we could see some downside risks to the valuation of where T-Mobile is currently trading at. And because of that, we're starting to see some signs where the technicals align with the fundamentals right now that give advantage to traders who are seeking more bearish exposure here in the equity markets. All right, let's look at some other bearish ideas here. Second here. One that I think that we gotta pay attention to here right now are some of the credit card companies. We've seen a bit of a slowdown here in terms of consumer spending, and what we really need to be familiar with is really how that's affecting credit card companies, especially if you see the substantial slowdown that we've seen in terms of travel spending. And that's really where American Express has a lot of exposure to, is in the travel segment. And historically, American Express, with a much more affluent client base, tended to be more immune to turndowns in consumer spending. But this is really where what their primary category of spending, which is on travel, has seen a pretty substantial decline here in terms of bookings throughout 2025 as a result of consumers being a lot more concerned around tariffs and potentially a pickup in inflation with regards to the tariffs. And that's really why we've seen that significant slowdown here in terms of travel spending. And I think that's going to have some ramifications on these premium travel cards like American Express has as their primary revenue source. So American Express trades at a pretty rich premium relative to the industry, even though it's not expected to grow any faster than the industry. And it's actually less profitable than its peers, yet it trades at a pretty substantial premium in terms of valuation. And I think that in an environment where travel spending is being reevaluated, there's a lot at risk given the relatively high valuation that American Express currently trades at. I'm gonna find the other bear stocks that we think are that we have to pay attention to. Another one that we might want to take a look at here is Penn Gaming. Penn Gaming trades at a very, very rich valuation here. And you can look at this. Let's actually pull out a little bit longer here to that weekly chart just to kind of see that long-term downtrend here. But what looked like a bit of a constructive move here on the weekly chart has turned out to be nothing more than a bit of a false sense, where it kind of traded in a range between 17.5 and then 22.5. Instead of breaking up to the upside, we actually broke down to the downside. So we broke down and all traded all the way down to roughly 12.5. We're trading back up to 15.5. And that's really where the downside risk here further is to the downside. For a stock that trades at 77 times forward earnings, that's not profitable in this type of market environment. Those are the types of stocks that get punished the most. And Penny Gaming certainly falls into that particular category. And one last company here within kind of the credit space, a firm, they provide the credit for a lot of high ticket items here, when you're buying them online, like for example, if you buy a Peloton bike, you can put it on Firm and it gives you kind of an interest-free loan or a low interest loan. As it kind of trades back near that major resistance level and the valuations that it trades at, those are some concerns that we see here, especially as consumers continue to pull back here on spending. So stocks like Affirm are going to have trouble, number one, growing their loan book, and then also potentially have some issues with delinquencies on their loan book. So companies like Affirm operate on pretty thin margins, and any shifts in terms of consumer spending or just the overall economy is likely going to have some pretty serious ramifications on its bottom line, certainly in terms of its net margins. So for those reasons, I think that there's some downside risks to stocks like Affirm and similar type stocks, that provide mostly consumer facing loans in this type of market environment for consumer durables, which, as a spending category itself, is highly sensitive to concerns around the shape of the U.S. economy and any slowdowns in consumer spending. So with that covers what I wanted to share with you here today. We find ourselves at a pretty pivotal moment here from an equities perspective that has shifted to a more positive tone here. But like I said, that shift in positive tone does come with some risk, and you don't want to be caught off guard with those particular risks. So make sure that you understand, looking at the treasury market, looking at kind of how bond markets are behaving and the concerns that bond markets may be expressing, and being sure that you are able to adjust accordingly here for your equity portfolio as well. With the ideas that I presented you here today. So with that covers what I wanted to share with you here today. I hope that this is helpful in giving you a better understanding of the big picture and some trade ideas here for the week. With that, thank you so much, and I hope you guys have a great trading day.